Today we're going to talk about one of the biggest lies that I've ever seen in my entire career, and that is the lifetime income rider that's often sold with variable annuities. The lie is that there is lifetime income. There is no lifetime income. It's a complete and total misrepresentation of the product that you're buying. All you're doing with this product is taking your own money out. So I'm going to show you how this misrepresentation works, what's really going on behind the scenes, how you're being ripped off, and what your alternatives are. I'm going to show you how to replicate one of these products and save yourself incredible amounts of money, not just in fees, but potentially in taxes as well. Because if you've watched my other videos on annuities, you know that annuities are tax disadvantaged. They don't have stepped up basis, and any gains in an annuity contract are taxed as ordinary income versus qualified dividends or capital gains. Annuities are bad when it comes to taxes. I've been a financial advisor for over 25 years. I've met with over 300 wealthy families in my career, and I've seen dozens and dozens and dozens of situations where families have been ripped off by someone who sold them a variable annuity with the promise of lifetime income. It is that empirical data set that I'm drawing upon for the information I'm about to share with you. I've seen lots of these variable annuities marketed with a 5% for life lifetime income guarantee. That's how financial planners sell them. They'll say to their client, hey, I can get you 5% guaranteed lifetime income. But it's not lifetime income. Again, you're just taking your own money out of the contract. So let me show you what the insurance company knows and how they're taking advantage of your fear of running out of money. Because that's what's happening here. These insurance companies and the financial planners who sell them, they know better. They have found a way to fee you to death, okay? They're selling you a product and playing on your emotions to get you to sign up for something that's a terrible deal. But they know on the other side of this what will happen from a statistical perspective. So I'm going to show you what they know and they're not telling you. Here's what the insurance company knows and they're just not telling you. We're looking at a 25-year illustration on $1 million investment made on January 1 of the year 2000 in the Vanguard Balanced Index Fund. This is a moderate allocation mutual fund, 60-40, just simple indexes. And we're taking $50,000 a year, a static 5% lifetime income, right? Out of this portfolio. Every year, $50,000 comes out. Look what happens. We start in the year 2000 with $1 million. 25 years later, at the end of November 2024, we have just over $1 million. We never ran out of money. And we're just using a very simple asset allocation fund. This is what the insurance company knows. You're not going to run out of money. So they're playing on your fears of running out of money and promising you lifetime income, but they're never going to pay you any income. All you're doing in a contract like this is taking your own money out. They don't have to ever pay a claim, so to speak. What they're insuring against is that if you did for some reason run out of money, which they know isn't going to happen, most likely, they would pay you your ongoing payment stream. The insurance company knows you'll probably die before that happens, so they and the financial planner who sold you this product have found a very sneaky, tricky way to put outrageous fees on you and earn a huge commission. All of these insurance companies that offer these variable annuities with lifetime income riders, they force you to use a balanced portfolio strategy just like we're looking at here. And they know that statistically, if they limit your distribution to a static 5%, it is very unlikely that you would ever run out of money. And that means it's very unlikely that they would have to pay a claim, i.e. maintain the timely payment of your 5% distributions. So most likely they're never going to have to pay any lifetime income to you. They're just metering out your own money and fooling you into thinking that you're getting lifetime income when you're not. If you own one of these products, or some so-called financial advisor or planner is trying to sell you one, please call my office. We'd be happy to give you a second opinion and a different perspective on your retirement planning. My best friend's family was a victim of one of these product sales. His father is a retired vascular surgeon. His mother is a retired executive. They've done well. They have a lot of money. Their so-called financial advisor, financial planner, clotheslined them in a bunch of these annuities, over $1 million worth, years ago, and never told them that he was getting massive commissions. They're locked into the things now, and they bought them. Why'd they buy them? They bought them because they're conservative people. They're worried about their money. They're worried about running out of money. And so they were sold this bill of goods. And now nobody's happy. Now they know the truth. They're frustrated, and they're stuck with these terrible products. It happens to people. It happens to very smart people. That's why I'm telling you this story. I've seen it happen to lots of sophisticated investors who were just outfoxed, outsold by some slick financial planner. Now that we've covered the misrepresentation, that the lifetime income really isn't lifetime income, let's talk about how you're getting ripped off and what your alternatives are. The ripoff is the excessive level of hidden fees that you are paying in one of these variable annuity contracts. You have to pay the hidden commissions to your financial planner. You have to pay the administrative costs to the insurance company. You have to pay the investment expenses of the mutual funds, and you have to pay for the cost of the rider or riders. Sometimes there are multiple riders. When you add it all up, you're typically around 3% per year in total hidden fees. That is an outrageous fee level, and it will hold your performance back over the long run. If you put $1 million in one of these products, that means you're probably paying $30,000 a year in total hidden fees. And let us not forget that when you bought the product, your financial planner probably got $70,000 in a commission, immediate commission, for 5 minutes of paperwork. Not bad for your financial planner. And that is why you're trapped in the contract for 7 years or longer. You can't get out without paying a huge penalty. It's called CDSC, Contingent Deferred Sales Charge. And that penalty exists to recoup the massive hidden commission paid to your so-called financial advisor. In addition to the fees, the tax structure of the annuity is a major negative. Any gains in the annuity contract will be taxed as ordinary income when those gains come out. And annuities do not qualify for stepped-up basis. What that means is that if you pass away and there are gains in the contract, your beneficiaries, your kids, are going to be responsible for paying income taxes on those gains. They could be inheriting a substantial tax liability, and they can't get away from it. Let's talk about your alternative. Your alternative is to invest in a balanced portfolio strategy and create your own distribution plan. You could do this on your own or with the help of a financial advisor. You will save a ton of money in fees by avoiding all of the costs associated with the annuity and paying for insurance that you probably don't need. Also, you avoid the tax complications of the annuity, which is a major benefit. Here's the data table for our Vanguard Balance Fund illustration. This is what you could replicate for yourself. Now, we don't know what the returns will be in the future, and yes, you could lose money, but you'll also save yourself a lot of money by avoiding all of the fees, hidden fees, in the annuity contract. We're starting the year 2000 with $1 million. We're taking a $50,000 static distribution off of our portfolio every year. Here's where we end up. We're ending up with $1,051,000 after 25 distribution years at the end of November 2024. This is how a balanced portfolio has performed over the last 25 years with a static 5% distribution. Notice that there's no inflation component with the distribution. And I did this intentionally because most of the annuities won't have an inflation ratchet either. They're just giving you a static 5%. I have other videos on the 4% rule where you take a 4% distribution and grow it by 3% inflation. I would encourage you to watch those videos so you can see other distribution strategies in retirement. I'll sum it all up with this. The financial planners who sell these annuities are among the most selfish salespeople in the world. There's just no way around that. You're not doing right by your client when you sell one of these products. We all know they're not in the best interest of the client. Between the fees, the tax complications, the lack of performance, it's just not a good deal for the client. Why would you ever try to sell this rubbish to your client? You only do it for one reason, and that's for the huge hidden commission. I hope this video was helpful. I hope it gets you thinking, helps you better analyze your investments, and overall improve your family's financial plan.